Today we're going to be talking about the geography of P&L impacts related to foreign currency movements, and we want to begin with the presumption that the lower on the P&L that income statement impacts can be realized, the more desirable that is. So if you don't operate under that premise, none of the following that I'm about to tell you holds true. But for the sake of argument, let's just assume for a moment that the CFO in your company is most interested in having stability in the revenue line as a primary objective, and that perhaps as a desirable yet lesser objective, stability in operating income, and subsequently between operating income and net income we find the characterization of other income and expense, which would constitute the remeasurement impact of balance sheet, hedging, and otherwise. So this is basically where you have a non-functional currency remeasuring into the functional currency of the entity. And then finally, the most desirable impact would be what they would characterize as an equity comprehensive income. And so this is basically an adjustment to equity that happens below the line of net income. So the reality of it is that in terms of what the true valuation of a firm is that it's the present value of its future cash flows, and none of these accounting geographies will have ultimately an impact on that. So at a theoretical level, none of this really should matter, but we're going to proceed forth in our discussion today using the premise that the farther down in the P&L that you can push foreign currency impacts, particularly related to balance sheet hedging, the more desirable. Okay, so there are basically two methodologies for setting a transaction rate. So this is the rate at which a company is going to recognize transactions throughout the month, and they're about equally divided. The first way that we observe in working with companies is what we would characterize as the the workday minus one spot rate. So, on December 31st, the company takes an observation of the spot rate, and all subsequent transactions are booked at that spot rate. And the second way to do it is use the actual daily rate. And the actual daily rate is basically where you book or you translate income statement events from non-reporting currencies into reporting currencies at the rate on the day which is observed. So you may have up to 31 different rates during the month at which you need to convert local currency or non-reporting currency transactions back into your reporting currency. So if you look at the dynamic on the workday minus one methodology as represented on the top here, you can see that all of the risk associated with currency movements has basically been forced into balance sheet remeasurement, and that there's very little income statement translation. There's actually no income statement translation risk associated with the workday minus one transaction rate setting methodology, because that rate is fixed. So if you observe a euro-dollar rate of 1.15 at the beginning of the month, and you book 100 euros of revenue, it doesn't really matter what happens to the euro throughout the month. You're going to recognize 115 euros of dollar equivalent revenue. Okay. The second methodology is the daily rate, which let's say throughout the month you recognize a certain amount of euro revenue. You're going to translate that euro revenue back into dollars at the observed rate. So let's say, just for example, the euro rate goes from $1.15 to euro all the way down to 1.05, and you book again 100 euros of revenue throughout the month. Well, your translated revenue for your income statement is going to actually be lower than what we observe in the workday minus one rate setting methodology example. So it's not going to be 115. It's going to be something closer to, for the sake of argument, we're going to use 107, or let's call it 107.5. Okay, so the difference is really that in the workday minus one example, you would take $115 worth of AR, and you would now translate that, and since the euro has dropped to 105, you would translate that into $115 of revenue into only $105 in accounts receivable. So 115 in revenue on workday minus one is going to be the rate you recognize, and workday minus one the following month, you're going to have 115 of AR. But then when the new spot rate comes in the following month at 105, workday minus one, that AR is going to be recognized down to only $105, and there's going to be what's called a remeasurement loss of $10. In the daily accounting rate setting methodology, we're just going to use, as an example, the average rate throughout the month to be 110 euros to the dollar, and basically at the end of the month you're going to have 110 of revenue. It's going to translate into 110 of AR, and then that 110 in AR is going to be remeasured down to 105 of AR. So you're going to have effectively only a $5 remeasurement loss in the daily accounting rate methodology, and you're going to have a $10 remeasurement loss in the workday minus one methodology. Well, yeah, what's going on there? Why is that? And is the workday minus one methodology better, or the daily rate? Well, it turns out that in the daily rate setting methodology, you only booked $110 equivalent of revenue, and so that's where the other $5 went on your P&L. And if you go back to the presumption that we were discussing previously, that would equate to a less desirable outcome. A lot of people think that if they can insulate the remeasurement, they're doing a good job, but the reality of it is that that's true, unless that comes at the expense of translated income that's impacted as a compensatory measure. So the last thing I'm going to talk about here is that we see a lot of companies that have this daily rate setting methodology, and they only have a balance sheet hedging program. Well, guess what? At the beginning of the month, you really don't have any balance sheet risk. It's only as the observations of the spot rate progress through the month that you start to accumulate accounts receivable fixed at those daily observations. And so what we see a lot of companies doing is that they actually start trading sometimes on a daily basis throughout the month, which is, if you take a step back, a bit silly, because they're only trading on a daily basis because they observed that the revenue risk that they have in that month is totally irrelevant. And so it's our observation that the trading, whether you use the daily rate or the workday minus one rate setting methodology, should really be the entire month's worth of transactions done workday minus one. And the trick that you can use to eliminate the need for daily trading and at the same time hedge your revenue is you basically recharacterize those revenue trades into balance sheet trades on every day during the month, just as your revenue is recognized. So this provides an offset, a P&L activity for revenue, and it also provides a hedge for your ultimate ending receivable that would mitigate any of your remeasurement effect. Obviously, both of these methods are subject to forecast error, but at the very least, you do a better job of managing your overall company risk by using a workday -1 hedging timeline. So a lot of people will say, "Oh God, what about hedge accounting?" Well, the reality of it is, hedge accounting is not applicable in this particular instance because all the revenue and all of the underlying hedging transactions are realized during the current month. So what we would advocate is people use what we call internal trades to recognize the split between the P&L impact on your contract and be able to bifurcate that into income statement or operational translation of the income statement and remeasurement impact in order to make your accounting folks happy and get the hedging activity into the right buckets. Okay, thank you very much for your time.